quite an important topic in crypto and in investing in general is the risk-return trade-off. You need to understand your risk profile. And this article here is from a really big article actually from Swissborg. And it's from the Swissborg Academy, The Ultimate Guide to Crypto Investing Strategies. This is a really good article that I wanted to go through on the HEXiKlub channel, but it's quite big and it would probably take around half an hour, which I think is a bit too long. And you'd get pretty bored really of me rabbiting on. So if you want to have a look at this, it's well worth the read, especially if you're a new investor in crypto or even a intermediate. Probably not needed for the advanced, but very good article. So one of the sections is this section here about the risk-return trade-off. And investing and risk go hand in hand, and cryptocurrencies are known for being a risky asset class. So this chart shows you on the left the level of risk and the potential returns of different types of investment. And so it starts off with cash here. So if you keep your cash in a suitcase under your bed, there's very little risk in it, but there's also very little chance of any kind of return. In fact, your cash is probably going to be diminishing because of inflation. So it's even better to keep it in a bank and get 1 to 2% interest, whereas if you keep it on you, you're getting 0. We then move to bonds and fixed securities. So you'll get a slightly higher return than cash, maybe around 5 to 6% or something like that. Property is the next one up, where you can make substantial gains from renting and from just holding a property in terms of capital appreciation. Then you move on to stocks, where you can see some of the big gains now coming in. So your level of risk is now a lot higher, but your level of returns is potentially very high. You can get double digits, triple digits now. And then right at the top is crypto. Biggest returns out there and also the biggest risk. You can lose it all very easily in crypto, or you can do a 10,000x maybe if you're one of the lucky ones. So if we look at levels of risk versus potential returns, that's the chart there. Sorry, that's the narrative for the chart there. The figure above highlights risk-return trade-off, showing the potential returns depending on the degree of risk you take, and both are linked to the type of investment you choose. You can see that cryptocurrencies at the top, while offering the highest potential rewards, investing in them is also riskier than other investments, mostly due to market volatility. We can see this within the crypto market, where smaller altcoins often have higher returns than Bitcoin or Ethereum, but they are also riskier because there isn't much history behind the project. So, should you put everything into the riskiest asset class because you want bigger profits? Generally, no. Most investment strategies will include some level of diversification. Understanding how much you invest in riskier assets versus safer assets will depend on your level of risk tolerance. Risk tolerance refers to the level of uncertainty or loss an investor is prepared to tolerate while carrying out his investment strategy. This depends on many factors, such as age. Younger investors generally take more risks as they have more time to wait for market volatility to even out. A 30-year-old investor who bought Bitcoin at its 2017 high could simply have waited until the price recovered in 2020. Whereas a 65-year-old investor who needed that money for retirement may have had to take a loss if they needed those funds immediately. Experience. If you have some investment experience, you might have discovered preferences for specific asset classes or projects. On the other hand, if you're brand new to investing, you might not know much about the crypto market, so don't feel comfortable putting in lots into crypto. Your experience will influence your risk tolerance. Time frame and goals. As we previously covered, each investor has a different investment goal and time frame. Usually an investor will be willing to take more risk if he plans on investing for a long period of time. Portfolio size. The larger your portfolio is, the more tolerant you may be of risk. A $100,000 portfolio, for example, will make it easier for an investor to take risks rather than a $1,000 portfolio. The bigger the portfolio investor is more shielded from the risks if the value decreases. Comfort level of an investor. Some people are naturally more comfortable with taking risks than others. Some investors will get stressed out by volatility, which can lead to bad investment decisions in volatile markets. These factors will all help you determine your risk tolerance, which can be measured on a scale from conservative, having low risk tolerance, to aggressive, having a high risk tolerance. So what you see here is the chart of investment risk tolerance. So low risk on the left hand side, high risk on the right hand side. There's the middle, the moderate section, and here is the ability to take risk, time horizons, assets, and the willingness to take risk, investing, experience and knowledge, attitude towards risk. So if you're at the far left of the scale, you're very conservative. Goal is capital preservation with little concern for potential gains. Then you move to moderately conservative. Primary goal again is capital prevention, but with some willingness to take some risks for gains. Then bang on in the middle, goal is to limit risk while generating positive returns. Next is moderately aggressive on the right hand side now. Goal is to generate positive long-term returns while accepting the need for elevated risk. And then here is the real aggressive approach. Goal is to maximize returns while accepting high volatility and periods of steep losses. Now we will consider the three main investor profiles based on their risk tolerance. Conservative investor. The main goal of the conservative investor is to protect his portfolio with little margin for capital growth. He accepts lower returns in order to get more stability and available liquidity. This kind of investor is able to take risk when necessary, but would prefer to avoid it. Moderate investor. The moderate investor values protecting his portfolio as much as increasing his returns. He will accept balanced risks and seek higher returns. While he is willing to take more risks than the conservative investor, he is not at the same level as an aggressive investor. Aggressive investor. The aggressive investor is pretty much the opposite of the conservative investor. This investor profile is eager to accept great risk as his goal is to maximize returns. An aggressive investor could potentially earn a lot more than the other two profiles, but could also be subject to much more volatility and potentially higher losses. To further highlight differences in these profiles, consider the following allocations for each of their portfolios. Asset allocation for conservative, moderate and aggressive portfolios. So we have an example here. This is the asset allocation going down, and then different types of portfolio. So you can see for a conservative portfolio, you may have something like 10% in alts, 20% in Bitcoin, Ethereum, and then the bulk of your holding is in fiat and stables. For the moderate, you up your altcoins to 25, you up your BTC and ETH to 35, and you reduce your fiat and stables. And then for the aggressive investor, it's the complete reverse of this. So you've only got 10% in fiat and staples. You're very aggressive with the altcoins, and then you up your Bitcoin and Ethereum holdings versus the moderate profile. Please note the numbers shown in the table are only an example. Yep. Like goals and timeframes, risk tolerance also influences the strategy you choose. An aggressive investor might be more comfortable with lump sum investing or growth investing because they're comfortable to take on larger risks and larger potential rewards. While a conservative investor might prefer dollar cost averaging for entering the market and then choosing investments that earn a yield rather than high growth investments. So that's a little segment there about the risk reward tolerance. So I hope you found that interesting.